Are you new to stock trading and want to learn how to pick the right stocks? If you are, this video is just for you. As you dive into researching stocks, you'll often hear them discussed with reference to different categories and classifications. Each type comes with varying privileges, levels of risk, and profit potential. If you're able to determine which kind of stocks best suits your financial situation, skills, and goals, you can find your niche in the multifaceted world of stock trading. It'll also help to focus your efforts in the right direction. Now, without further ado, let's dive right into the types of stocks that every investor must know before they make their investment decisions. We'll start with two of the main kinds: common stocks and preferred stocks. When a company sells shares of stock to the public, those shares are typically issued as one of the two main types of stocks: common stock or preferred stock. Common stock is the most widely traded stock in the market. This stock represents partial ownership in a company. This means that when you own common stock, you own a share in the company's profits as well as the right to vote. If a company does well or the value of its assets increases, its common stocks will go up in value. However, if it performs poorly, then the value will decrease. Common stock gives shareholders theoretically unlimited upside potential, but they also risk losing everything if the company fails without having any assets left over. Preferred stocks, on the other hand, is a little different. Just like common stocks, they do represent a share of ownership in a company, but give shareholders a preference over common shareholders to get back a certain amount of money if the company dissolves. Preferred shareholders also get another preferential treatment. Dividends are paid to preferred shareholders before common shareholders, even in the case of bankruptcy or liquidation. Well, these are just two broad categories of stock. Stocks can also be further divided into other types based on dividend payment, market capitalization, risk, and price trends. We are now going to cover all these additional types of stock in detail. Income stock and growth stock. On the basis of how much dividend the company pays, stocks can be classified into two types: income stock and growth stock. Simply put, income stocks are stocks that pay consistent and steadily increasing dividends. This type of stock can be found in large and stable companies, primarily in real estate, natural resources, and energy sectors. Experts consider these stocks to have a low level of volatility and offer a high dividend payout ratio. A perfect example of income stocks is those of retail giant Walmart. Over the last 30 years, Walmart's stock price has risen consistently. This has enabled the company to pay rising dividend yields to its stockholders. However, not all stocks pay high dividends. This is because companies prefer to reinvest their earnings for company operations. This usually helps the company grow at a faster rate. As a result, such stocks are often called growth stocks. These stocks are essentially shares in those companies that are generating positive cash flows and whose earnings are expected to grow at an above-average rate relative to the market. The potential returns can be extremely attractive. Is there any risk associated with this type of stock? Well, yes. If a company's growth expectations are not as anticipated, eventually shareholders might lose money because the share prices will drop. For this reason, investors choose such stocks for their long-term growth potential and not for a secondary source of income. Value stock. Value stocks are stocks that trade at a lower price relative to a company's earnings, sales, dividends, and other business fundamentals. This type of stock is particularly appealing to those investors who look for companies with inexpensive share prices, trading at a lower price than what the company's performance may otherwise indicate. One of the advantages of value stocks over other types of stocks is that they offer excellent profit potential. They're often mature, well-known companies that have already grown into industry leaders. However, value investing requires a lot of patience. It can take years before value stocks become profitable. It can also be extremely challenging to identify these kind of stocks. Small cap, large cap, and mid cap stocks. Stocks also get categorized by the total worth of all their shares, which is called market capitalization. Here, stocks can be classified into three types: small cap, large cap, and mid cap stocks. As the name suggests, small caps are stocks with the smallest values in the market. They often represent small-sized companies. The definition for small cap varies, but it generally means a company with $300 million to $2 billion in market capitalization. Large cap refers to a company with a market capitalization value of more than $10 billion. Due to their size, large cap stocks are generally believed to be safer. Also, these are typically used as core long-term investments in an investment portfolio because of their stability and dividends. Now, for investors who want the best of both worlds, you might consider mid-cap companies which have market capitalization between $2 to $10 billion. Historically, these companies have offered more stability than small-cap companies, yet confer more growth potential than the large caps. Cyclical and non-cyclical stocks. National economies tend to follow cycles of expansion and contraction with periods of prosperity and recession. Prices of stocks often move in tandem with the economy. Stocks are thus classified into two groups, cyclical and non-cyclical stocks. A cyclical stock is a stock that's price is affected by macroeconomic or systematic changes in the overall economy. These stocks are known for following the cycles of an economy through expansion, peak, recession, and recovery. The economic downturn can easily take away customers' ability to make major purchases quickly. When economies are strong, however, a rush of demand can make these companies rebound sharply. Unlike cyclical stocks, non-cyclical stocks, also known as secular or defensive stocks, are issued by companies relatively unmoved by economic conditions. Best examples are stocks of companies in the food, beverages, drugs, and insurance sectors. These stocks repeatedly outperform the market even when economic growth slows down. Blue chip and penny stocks. Blue chip stocks are stocks of large, financially stable companies that are usually one of the leaders in the respective industry. But why are they called blue chips? Well, this is in reference to the blue-colored chips in the game of poker, as those chips are considered the most valuable. These stocks are issued by companies who have been on the market for a long time, and as such, their market cap is estimated to be in billions. They also have dependable earnings, often paying regular dividends to their investors. That's why, as proud and proven companies, many investors consider them safe. Some popular examples of blue chip stocks are IBM, Coca-Cola, and Boeing. While it is believed that blue chips can survive market challenges of many kinds, and this is largely true, it is not a 100% guarantee though. Now, penny stocks, on the other hand, are nearly the opposite of blue chip stocks in every possible way. These stocks are often defined as shares that trade for less than $1. The Securities and Exchange Commission, however, defines them as stocks trading for less than $5. They are mostly young companies and they're all small, but they are anything but boring. Penny stocks are almost always involved in riskier ventures, such as finding mineral deposits that can be mined at a profit, commercializing unproven technologies, or launching new software. With dangerously speculative business models, penny stocks are prone to schemes that can drain your entire investment. You can definitely get lucky in penny stocks, but it is just as in a lottery. However, there are some interesting prospects, including some promising newcomers. It's the best that you do ample research before investing in penny stocks, and make sure you don't spend more than what you can afford to lose. ESG investing stocks. One approach that has been very popular lately, and you may have heard about this often, is ESG investing. ESG is an investment philosophy that puts emphasis on environmental, social, and governance concerns. Environmental criteria consider how a company performs as a steward of nature. Social criteria examine how it manages relationships with employees, suppliers, customers, and the communities where it operates. Likewise, governance deals with a company's leadership, audits, shareholder rights, executive pay, and internal controls. In recent years, younger investors in particular have shown an interest in socially responsible and sustainable investing. As such, rather than focusing entirely on whether a company generates profit and it's growing its revenue over time, investors also consider other aspects such as collateral impacts on the environment, company employees, and customers. Now with this, we've come to the end of our video. Now that you know about all these major types of stocks, you can start by investing in the right one for yourself. With thousands of stock in the market, this process can really be daunting. Especially if you're new to the market, investing in stocks can be pretty overwhelming. In that case, we have another video where some of the most important questions about the stock market have been answered in order to guide you with your investment in stocks. Make sure you check that one out. Please leave a thumbs up and share the video if you found it to be useful. For more videos like this, subscribe to our channel and hit the notification bell to never miss an upload. See you guys in the next one.